Hello, my name is Rans, and today we are going to talk about a company that has been rapidly growing and it has become one of the bigger players in its industry. But before we start, please remember this is not investment advice. We're just trying to understand the financial performance and position of the company. So let's get started. The company that I am talking about is HCL Technologies, right? So much like it is a company in the IT services industry, it creates technology products and platforms for other businesses to use. It helps them with their digital and all the software related products that they have to use. I remember I have also seen a few laptops, but that were being made by HCL back very a lot of years back. But I think right now I don't think that happens. So it is more or less a B2B company that provides IT services and products to other businesses. So let's start with the financials of the company. If we the growth that I was talking about here, right? So if we look at the revenue, EBIT, and PAT, so revenue is up 4.5 times, EBIT is up to 7 times, and PAT is up to 6.7 times. And this is something that is unique. I found to HCL that the growth in EBIT and PAT is actually greater than the growth in revenue, and this is not the trend with, let's say, an Infosys or a TCS, right? So if you look at the CAGR, so the EBIT and PAT CAGR are very healthy, around 24 and 23.6%. So these are very, very good figures, right? So the company has grown quite rapidly and the growth rates have been very healthy. Now, talking about the CFO, so the cash conversion also, so to speak. So first of all, the growth in CFO is also very strong. In fact, it's even better than the EBIT or the revenue or the PAT growth, right? And the cumulative CFO is around, let's say, 97, 98% of the cumulative PAT, so 64 to 80 here and about 66,000 crores here, right? And again, this is something that is better than, let's say, the industry leaders like a TCS and Infosys, for which the 10-year cumulative cash flow was around 85 to 90% of the cumulative profit, and this company is operating at about 97, 98%. Right now, talking about the cash flow from investing activities, so here the company has been making regular investments into its assets, but apart from that, like most other IT companies, it has also had a lot of purchase and selling of investments because the company generates a lot of cash as well. The cash flow from financing is one aspect where the company again differs from its competitors in the sense, at least the industry leaders, in the sense that it has had a lot of borrowing transactions in almost all the years. So in every year, the company has either repaid borrowings or issued borrowings, or in fact, in a lot of years, the company has had both transactions. Right? Dividends are also being consistently paid by the company, but borrowings also form a good part of the cash flow from financing or the cash outflows related to financing, so to speak. Now, coming to the balance sheet item, starting with equity, again, very strong, solid growth in equity. This is here at 6.7, it is up 6.7 times, right? And if you look at the current assets and the non-current assets, so current assets have also gone up considerably. A large part of it would be investments as well. Non-current assets, the company has continuously reinvested into its non-current assets, as we also saw that here the company had a major investing related outflow and the asset base has also increased. So this might be due to an expansion, but I think there might also be some part of investment transactions here rather than just the fixed assets, because all of these non-current assets are obviously not fixed assets, right? Now, talking about the current liabilities, the growth in current liabilities more or less in line with the revenue, and the growth in current assets is slightly higher than that in revenue. The growth in current liabilities is almost equivalent to the growth in revenue, so that is the trend there. Non-current liabilities. So despite all the borrowing related transactions that the company has gone through, the solvency position is very comfortable. The non-current liabilities currently at their 10-year high, and that figure is still very insignificant versus the equity that the company has, or versus the value of the equity. So non-current liabilities currently at 5,400 crores and equity is about 51,200 crores. So from a solvency perspective, also very comfortable for the company. And if you look at the total liabilities, so that is about what, 28, 29,000 crores, and the current assets only are about 38,000 crores. So that is something that you will see commonly find among a lot of IT companies as well. Now, talking about the growth of the high level financials, as we saw very solid growth, just 1 year here where the growth wasn't that great, and in fact it was degrowth. but it bounced back. The company bounced back very strongly in the next year, and again a year of poor growth. But then the recent 2 years have seen very good growth. Although if you look at the other IT companies, they haven't had the best of growth in the last 3 to 4 years, and this company has had just one poor year in the last 4 years, or let's say two poor years in the last 10 years, right? But recently the other companies haven't, or the IT industry as a whole hasn't grown very rapidly, but this company has had very good growth. And let's see if it can continue this momentum into the next 2 3 years, which seem to be better than the previous 3 to 4 years for the IT industry. Cash flow from operations slightly more volatile. That's understandable, right? Equity, again, solid growth rate in equity. Assets have also more or less grown, except for a year here where there seems to be something that either the company let go of some of its assets or let go of some of its business. But yeah, apart from the year there has been continuous investments into, or continuous accumulation of assets. Current assets less current liabilities, slightly volatile. That is understandable on part of the company, but current assets are sufficient to cover the current liabilities. Liabilities, although the growth rates seem higher, but they don't really matter a bit. They don't really matter a lot, to be honest, because the liabilities are an insignificant or a very small part of the entire balance sheet, right? Especially the non-current liabilities, and current liabilities are easily being covered by the current assets. So now talking about the metrics, so starting with the return on capital ratio, so it seems that in fact there has been sort of trend. So the company had very good years here, so increasing here, but then after that the company was on a bit of decline, and then again it has recovered to operate in some sort of range in these years. And this sort of trend can be traced to also EBIT margin as well. So EBIT margins also expanded up to this point. So these couple of years were very good, and then they kind of declined, and now they've been more or less very in a specific range and very stable, so to speak, right? So that is the trend that can be observed in return ratios and also the margins. Talking about the capital turnover and asset turnover, capital turnover and asset turnover also have some sort of a similar trend. So it seems that these 3 or 4 years here for the company were sort of very good, and after that the company has sort of been stable with respect to its performance, so to speak, right? Now talking about the leverage, solvency, and the liquidity aspects. So assets by equity for all the borrowings, still the financial leverage has never gone above 2, so the company is very comfortable in that aspect, with all the borrowing, even with all the borrowing transactions going around. Cash conversion was very strong in these years. It fell a little in these 2 years, and then again it has gone up on the stronger side. A slightly lower year here, and then again it has increased. So cash conversion has been on the stronger side for this company versus let's say the industry leaders as well. Net cash flow position. So if we talk about the net cash flow position, it is on the positive. The company does produce a lot of operating cash flow from which it can invest into its assets, also pay back to its shareholders. But there have also been borrowing related transactions as well in the company. The current assets and less current liabilities. So obviously this is a very big difference here, in fact, right? And although in the last 4 to 5 years or 5 to 6 years, in fact, the company has had it relatively stable, and a large part of these would actually also be investments that the company holds. Finally, the non-current liabilities to equity. So as we talked about it, very insignificant non-current liabilities, so to speak, versus the equity position. So from that perspective, it's very comfortable for the company. All right, now quickly let's wrap up with the highlights. So strong revenue growth and very strong EBIT and PAT growth for the company, and in fact very strong cash flow growth as well for the company. Right, CFO has been greater than PAT in 5 out of the 10 years, and cumulative PAT is slightly lower than cumulative. Sorry, cumulative CFO is slightly lower than cumulative PAT. Right, so if we in fact look, let's just quickly take a look at the percentages. So it's around 97.4%. So cumulative CFO is 97 points. So it's almost equal to PAT, right? Continuous reinvestment into assets and investment transactions as well, with all the excess cash that the company uses to buy and sell investments. CFF primarily includes borrowings and dividends. So borrowings are actually the primary transaction, although the issue and also the repayment of borrowing nets out, but still there has been a lot of amount that is due to a lot of financing flows, primarily due to borrowings, and dividends are also a part of the cash flow from financing. Right. Strong growth in equity, thus as we've seen, comfortable solvency position and investments are held as current assets. So financial leverage has never exceeded 2x and non-current liabilities are just insignificant, so to speak. Return on capital employed greater than 25% in 7 out of the last 10 years and return on equity greater than 20% in all of last 10 years, right? So these return ratios have been operating in sort of range, and as we saw the trend that initially they increased, then they slightly decreased, and then they have been maintained in the last 3 to 4 years, right? EBIT margins and PAT margins have broadly been maintained as we saw, although they expanded in the initial years of this uh, 10-year period. And then in the recent years, they've been more or less stable. Same thing goes with capital and asset turnovers as well. They have broadly been maintained. So that is the sort of trend that we've seen in the return on capital, EBIT, and asset utilization. So the conclusion is that this company has a strong financial position and performance as well, and it has had solid growth. In fact, it has had better growth than, let's say, an Infosys or a TCS in that aspect. Obviously, it's still not at the scale of either of those companies. It's slightly smaller than those companies, but still the growth has been very strong. And let's see how it can grow in the coming 2 to 3 years. So that is all I had to share about this company. I hope you found this helpful. If you have any questions, then you can drop them in the comments. The link to this Excel worksheet is available in the description, right? So if you found this helpful, please share it and subscribe to the channel because I cover new companies every day. Thank you so much for watching, and I'll see you again with another company.